If you clicked on this video, it's probably because you're looking for a real, profitable trading strategy. And trust me, you are exactly in the right place. Today, we're not going to talk about magic, complicated indicators, or vague strategies. Today, I'm going to show you 5 simple, powerful, and truly profitable price action strategies used by professional traders every single day. Here, we will work only with price, market structure, and trader psychology. If you truly master these concepts, you can trade any market, Forex, gold, indices, or even crypto in a clean and disciplined way. But be careful, this is not a video for people who are in a hurry. This is a video for those who really want to improve and become consistent in trading. Before we continue, take 2 seconds to subscribe to the channel and like the video. This small gesture helps the Max Take Profit channel grow a lot and motivates me to bring you even more high-quality content. And most importantly, watch this video until the end, because the last strategy is one that very few traders truly understand, but that institutions use every single day. All right, enough talking. Let's get straight to the point. The first strategy is called Breakout and Retest. The concept is very simple. The price breaks an important level, such as a support, a resistance, or a trend line. Then it comes back to test that same level. And very often, what was resistance becomes support, and what was support becomes resistance. We do not enter on the breakout. We wait for the price to come back, and we look for a clear rejection or a clean pullback. The stop loss is placed behind the retest zone. The take profit is placed using a risk-to-reward ratio of 1:3 or on the next important level. After the backtesting I did recently, this strategy shows a win rate of around 70%. That means out of 100 trades I backtested, 70 were winners and 30 were losers, when the strategy is properly filtered. So in conclusion, this strategy is profitable if you follow the rules strictly. Mistakes to avoid. First mistake, never anticipate. Never place a limit order right after the breakout, hoping that the market will come back for a pullback. That is dangerous because the market is unpredictable. It is always better to wait for all confirmations before entering the trade. Second mistake, never enter directly on the breakout. Many traders enter because they are afraid of missing the opportunity. That is a big mistake. You must always wait for a clear pullback after the breakout before entering. Third mistake, do not trade false breakouts. A breakout is considered valid when it is made with the body of the candle, not with the wick. Fourth mistake, never trade against the trend. Always trade in the direction of the trend. For example, imagine you have an opportunity like this. You can clearly see that the market is in an uptrend, but the setup you want to take is bearish. Here is why you should not take this trade. For the trend to be considered bearish, the market must break this important zone that caused the strong bullish move. As long as this zone is not broken, the trend remains bullish. So all our trading opportunities must stay bullish. The second strategy is called the engulfing pattern after retracement. This strategy uses momentum strength to confirm the end of a correction and the continuation of the main trend. 1. What is an engulfing candle? An engulfing candle is a candle that completely covers the body of the previous candle. In an uptrend, we look for a bullish engulfing pattern. In a downtrend, we look for a bearish engulfing pattern. This candle shows something very important. One side of the market has completely taken back control. 2. Market context. This strategy works only in a clear and established trend. In an uptrend, we only look for buying opportunities. In a downtrend, we only look for selling opportunities. Do not trade this strategy in a ranging or sideways market. 3. The retracement zone. You should never trade an engulfing candle at random. In an uptrend, wait for price to pull back slightly toward an important technical or psychological level, such as a support, a structure zone, a trend line, a psychological level, or a Fibonacci retracement 50% or 61.8%. In a downtrend, it's exactly the opposite. 4. The signal, the engulfing candle. The entry signal is a clear and clean engulfing candle. In an uptrend, a bullish candle that completely engulfs the previous bearish candle. This shows that buyers have fully regained control. In a downtrend, a bearish candle that completely engulfs the previous bullish candle. This shows that sellers have fully regained control. The larger and more impulsive the engulfing candle is, the stronger the signal. 5. Entry. The entry is taken at the close of the engulfing candle. Never anticipate before the candle closes. 6. Stop loss placement. The stop loss is placed for a buy below the low of the engulfing candle, for a sell above the high of the engulfing candle. Why? Because if the price breaks this candle, it means the signal has failed. 7. Take profit, profit target. You have two main options for take profit. Main target. In an uptrend, the previous swing high. In a downtrend, the previous swing low. Or use a risk to reward ratio. Minimum 1 to 2. Ideally 1 to 2. 1 to 3 or more. Win rate. When used correctly, in a strong trend and at a proper retracement zone, this strategy can reach a win rate of around 65 to 75%. Mistakes to avoid. Trading an engulfing candle in the middle of nowhere. Trading against the trend. Trading without a clear retracement zone. Entering before the candle closes. Trading in a ranging market. Key sentence to remember. It's not the engulfing candle itself that's powerful. It's where it appears and the trend context behind it. Best pairs and markets. Euro dollar, GBP US dollar, XAU USD, gold, NASDAQ US 30, GBP JPY. Recommended timeframes. M15 for intraday, H1, H4, and daily for cleaner and more reliable signals. The higher the time frame, the more reliable the setup. Conclusion. The engulfing pattern after retracement is a simple, powerful, and highly effective strategy, but only if it's used in the right direction, at the right level, and with discipline and patience. The third strategy is called double top and double bottom. It is a market reversal strategy that is very well known and very effective when used correctly. 1. What is a double top and a double bottom? A double top appears at the end of an uptrend. The market makes two highs at almost the same level, but fails to continue higher. A double bottom appears at the end of a downtrend. The market makes two lows at almost the same level, but fails to continue lower. These patterns show something very important. The market is losing strength. 2. Market context. This strategy works only after a real trend. Double top after an uptrend, double bottom after a downtrend. Do not trade this pattern in a ranging or directionless market. 3. The neckline. Key level between the two highs or the two lows. There is an intermediate level. This level is called the neckline. The pattern is only valid when the neckline is broken. 4. Entry. There are two clean ways to enter. Option 1. Aggressive entry. Enter immediately after the neckline break. Option 2. Safe entry, recommended. Wait for the neckline to break, then wait for the retest of the neckline. Enter after a clear rejection. Personally, the second option is much safer. 5. Stop loss placement. The stop loss is placed for a double top above the second high, for a double bottom below the second low. Why? Because if price comes back above or below these levels, it means that the pattern has failed. 6. Take profit, profit target, technical zones. You can target the next important support or resistance. In all cases, aim for at least a 1 to 2 risk to reward ratio and ideally 1 to 3 or more. Win rate. When used correctly with break and retest, this strategy has a win rate of around 60 to 70%. Mistakes to avoid. Trading against a strong trend that is still valid. Trading in a ranging market. Not waiting for confirmation. Key sentence to remember. A double top or a double bottom is only valid when the neckline is broken. Best pairs and markets. XAU USD, gold. NASDAQ US 30. GBP JPY. Euro USD. GBP USD. Recommended timeframes. M15 for intraday, H1, H4, and daily for the cleanest and most reliable setups. The higher the time frame, the more reliable the pattern is. Conclusion. The double top and the double bottom are simple, powerful, and very effective strategies, but only if you wait for real confirmation and trade in the right context. Before we continue with the fourth strategy, take just 2 seconds to like the video and subscribe to the channel if you haven't done it yet. It helps the channel grow a lot and motivates me to bring you even more high-quality content. Thanks for the support. And now, let's move on to the fourth strategy, which is one of the most powerful. The fourth strategy is called head and shoulders. It is one of the best trend reversal patterns and also one of the most reliable when it is used correctly. 1. What is a head and shoulders pattern? This pattern usually appears at the end of an uptrend. It is made of 3 highs. A left shoulder, a head, higher than the 2 other highs, a right shoulder, often at the same level as the first one. This shows something very important. The market is trying to move higher, but it no longer has enough strength to continue. There is also the inverse version, the inverse head and shoulders, which appears at the end of a downtrend. 2. Market context. This strategy works only after a real trend. Normal head and shoulders after an uptrend. Inverse head and shoulders after a downtrend. Do not trade this pattern in a ranging or directionless market. 3. The neckline, key level. Below the highs, there is an important support level. This level is called the neckline. The pattern is only valid when the neckline is broken. Without a break of the neckline, there is no trade. 4. Entry. You have 2 methods. Option 1. Aggressive entry. Enter immediately after the neckline breaks. Option 2. Safe entry, recommended. Wait for the neckline to break, then wait for the retest of the neckline. Enter after a clear rejection. As always, the safe entry is the best option. 5. Stop loss placement. The stop loss is placed for a normal head and shoulders above the right shoulder, for an inverse head and shoulders below the right shoulder. Why? Because if price comes back above or below this level, it means that the pattern has failed. 6. Take profit, profit target. Take profit can be set at the next important support or resistance. In all cases, aim for at least a 1 to 2 risk to reward ratio, and ideally 1 to 3 or more. Win rate. When used correctly, with break and retest, This strategy has a win rate of around 65 to 75%. Mistakes to avoid. Trading the pattern before the neckline breaks. Forcing a pattern that is not clean. Trading against a trend that is still strong. Trading in a ranging market. Not waiting for confirmation. Key sentence to remember. A head and shoulders pattern is only valid when the neckline is broken. Best pairs and markets. XAU-USD, Gold, NASDAQ, US30, GBP-JPY, Euro-USD, GBP-USD. Recommended timeframes. M15 for intraday, H1, H4, and daily for the cleanest patterns. The higher the time frame, the more reliable the pattern is. Conclusion. The head and shoulder strategy is simple, powerful, and extremely effective, but only if you wait for the real breakout and trade in the right context. I hope everything has been clear so far, and if it's not the case yet, don't hesitate to leave your questions in the comments. I'll reply as soon as possible. The goal of this video is simple: to help you reach profitability without going through years of mistakes and failures. The fifth strategy is called the pin bar and a confluence zone. A pin bar is a very special reversal candle. It is easy to recognize. It has a long wick and a small body. This long wick shows something very important. The market tried to move in one direction, but it was violently rejected. But be careful. A pin bar alone is not enough. It becomes powerful and reliable only when it appears at a key level and in the right market context. 1. Market context greater than. This strategy works much better in a clear and strong trend. First, you must identify either an uptrend or a downtrend. Do not trade this strategy in a ranging or sideways market. 2. Confluence zone. Confluence means several technical elements coming together in the same area. The best confluence zones are a support or resistance, a trend line, a structure zone or a gap, or a Fibonacci level, such as 50% or 61.8%. The more elements meet in the same area, the stronger the zone is. Our pin bar is only valid if it appears in one of these zones. 3. Entry. The pin bar greater than. The entry signal is a well-formed pin bar and always in the direction of the trend. In an uptrend, the wick of the pin bar must point downwards. The rejection shows that sellers have been absorbed by buyers. In a downtrend, the wick of the pin bar must point upwards. The rejection shows that buyers have been rejected by sellers. The longer the wick, the stronger the rejection. 4. Stop loss placement greater than. The stop loss is placed a few pips beyond the tip of the pin bar's wick. Why? Because if price goes beyond that wick, it means that the rejection has failed and your scenario is invalid. 5. Take profit. Profit target greater than. The take profit must respect at least a 1 to 2 risk to reward ratio. Ideally, 1 to 2 minimum, 1 to 3 or more when the market allows it. You can also target the next high in an uptrend or the next low in a downtrend. Win rate greater than. When used correctly, in a strong trend and on a real confluence zone, this strategy can reach a win rate of around 75%. Mistakes to avoid. Trading a pin bar in the middle of nowhere. Trading in a ranging or messy market. Trading a pin bar against the trend. Trading a pin bar without confluence. Entering without waiting for the candle to close. Key sentence to remember. It is not the pin bar that is powerful. It is the place where it appears that makes all the difference. Best pairs and markets. EURUSD, GBPUSD, XAUUSD Gold, NASDAQ/US30, GBP JPY. Recommended time frames: H1, H4, daily, and weekly for the cleanest and most reliable trades. The higher the time frame, the higher the win rate. Personally, my backtests were mainly done on H4. Conclusion: the pin bar in a confluence zone is a simple, clean, and very effective strategy, but only if it is used in the right context, with discipline and patience. Now you know 5 simple, powerful, and effective price action strategies. Today, we covered breakout and retest to trade breakouts the right way, pin bar in a confluence zone to enter at the right place with precision, double top and double bottom to spot market reversals, head and shoulders, one of the most reliable reversal patterns, and finally, the engulfing pattern after retracement to catch trend continuation with momentum. But let me tell you something very important. It's not the strategy that makes you profitable. What really makes the difference is discipline, patience, risk management, and above all, consistency. You can have the best strategy in the world. If you don't respect these rules, you will still lose. Advice to really improve your results. Here is what I strongly recommend you to do. 1. Do not trade every opportunity. Only trade the cleanest setups. Quality is better than quantity. 2. Always respect risk management. Never risk more than 1 or 2% of your account per trade. 3. Always wait for confirmation. Most losses come from impatience and anticipation. 4. Stick to one strategy at a time. Do not jump from one strategy to another. Master one single strategy and you will already be better than 90% of traders. 5. Backtest and keep a trading journal. That is how you understand what really works for you. Very important sentence to remember. Trading is not a sprint. It is a marathon. The winners are the ones who survive long enough in the market. If this video helped you, like it, subscribe to the Max Take Profit channel, and tell me in the comments which strategy you are going to start working on first. And most importantly, remember, no luck, only strategy.